Hello my fellow freedom builders and welcome back to the channel. Today we're going to have a video about a topic I have been asked a lot about, and that is the REITs. Well, if you don't know what a REIT is, then it is a real estate investment trust that is constructed in a way so you can actually kind of invest directly into properties, but without all the hassle of actually managing the properties yourself. But you can be a part owner of a company investing, for instance, in malls or hotels or whatever it could be that is real estate. So this vehicle investment instrument has been very popular for quite a lot of years, and especially since the financial crisis in 2008. And people have used it to get some good solid dividends. Some of them are paying out 3 to 4%, some are 8 to 10%, but of course there are different risks depending on what dividend you're going for. Those of you not too familiar with REITs, and I guess that if you're sitting in the United States right now, you're thinking, why on earth is he explaining to me what a REIT is? But if you come from Europe and in Denmark, where I'm located, actually not that many people are aware of the structure and the possibilities of the REIT. So basically, just to give you a very quick glance here, a REIT can either be an equity REIT or a mortgage REIT. And the difference here is actually in the words themselves. An equity REIT owns the actually building. So an equity REIT could own a mall. That could be a chain of buildings where the malls are located. Of course, they don't own the mall, but they own the building. That could be Walmart's buildings, because Walmart's, they don't really want to manage their own buildings. So there's a property company owning the buildings, and of course they need some money. So they are buying them through a REIT where normal private investors can invest. So they actually own the equity, collecting the rent, doing the day-to-day management, or at least that is the basis version. There are also all sorts of mixed versions. But then there's a mortgage REIT, and the mortgage REIT don't actually own the building, or at least in the normal cases they don't, because what they do is that they take some short-term loans at a low interest, and then they buy mortgages, meaning they could buy them from Fannie Mae, Freddie Mac, all of these real estate mortgage constructions. They could also buy some that were government backed, but they actually buy, you could say they buy debt. They buy mortgages, so they're collecting a rent on this mortgage, and let's say they can borrow money at 1% or 1.5% at short-term interest, meaning that they will have to refinance every second, third year, something like that. And then they are buying a long-term mortgage on, let's say, 20 or 30 years, and collecting the difference there. Maybe they're paying 1% in interest on their short-term debt, but they are collecting 4 or 5% on their long-term mortgage, meaning they are cashing in on the difference. So that of course is very smart. They don't have all the management and collecting rent of all this sort, but they are, as we are going to look at today, they're taking on another sort of risk, because what I'm going to talk about is a little word with 4 letters. And no, it is not REIT, it is risk. Because what people have realized now with the crash here in the spring this year, due to the due to the virus, but also due to the fact that we were at the end of an economic cycle, and that mixture of that have made people realize that they are actually taking on a risk in the REIT investment that they were not really aware of. When we're looking at the REITs, of course, it can't be just let's just have a graph. We'll look at this one later. We can invest in REITs through an ETF. And of course, with all other equity ETFs and so on, an ETF is an exchange traded funds, and they buy up in different REIT companies and collect them in an ETF. And here we have the VNQ, which is, as far as I can tell, the largest REIT ETF. And if you don't want to research yourself, then you're just covering the entire market, as always, by buying an ETF. However, as you can see here, the market has actually, the overall stock market has pretty much gone back to the level before this virus crisis in the spring. But as you can see here, the last V and Q here is still down 15%. And at the worst point, it was down something like 40%, and there were that was actually just since the new year here, but from the top to the bottom, let's see, something like 45%. So they went down more than the market, and they haven't recovered yet. When we're looking at the price of a REIT, we should realize that we cannot really compare it to the trend graph of another stock, because what is in the nature of the REIT is that they have to pay out, or at least that is the US rules. I'm not completely aware of the rules in Canada and other parts of the world, but in the United States, the REIT has to pay out 90% of its earnings in dividends. And that is, of course, very interesting for dividend investors, because they are getting pretty much all of the earnings back out into their pocket, so they can spend it or they can reinvest it. So when we're looking at the V and Q here, let's just have a look at where we're just looking at the weekly chart here. Then normally we would say, well, this is not very interesting. You could have invested in it in February 16, and by now you would have made 0%. That is true in the stock price or ETF price appreciation wise here, but you would have collected a dividend, and I think on the V and Q it is something around 4%. I might be wrong here, but somewhere around 3 or 4%, maybe a bit more. So you have been collecting that at least. That is not at all the same as the market. You would have been making a better deal investing in the market. And then some would say, yeah, but I'm investing in real estate and that is much more solid. Well, is it now? Of course, you could be lucky to have bought back here and just made a scratch plus your dividend, but you could also have been very unfortunate and buying just around here and getting a divorce or someone getting sick or whatever, what else happens in life, and have to get out down here. You might have collected a bit of dividend, but you would be down 43%. And you might think to yourself, yeah, well, that is also the worst case at all you can find. But you will be amazed if you have been investing for 10 years, how often you hit the worst case when you invest. So pretty much by all of these drops here, drops 20%, 20%, 22%, 45%. So the REITs is not a guarantee for you to get a linear development in your equity. Not at all. So let's have a look at some of what has been happening lately. Because what we saw with the virus here in the spring is that a lot of the rent that these REITs should collect, they were not able to collect. And there was several reasons for that. Let's just have a look at them here. As you can see, on the industrial side, because there are different REITs investing in different sectors. And some of them could be investing in industrial. And you can see April, May, June, they were able to collect most of what they expected in rent. Apartments, a bit lower in April, where it really hit with the crisis, and then higher in May and June. This is partially due to the government help program in the United States, so that people actually got a bit of money in their hands. We can see that the office spaces were not that hard hit, and healthcare also not the worst. But if you were unfortunate to be investing in something in retail, that could be freestanding shops, or it could be shopping centers, malls, and so on, you can see you were collecting somewhere between 45 and 80% of your rent. And in many of these REITs businesses, that is really, really hard. It should be said that after the financial crisis in 2008, where the REIT business was really completely torn apart. That was a train wreck, if anything was. they have consolidated a lot, definitely. So many of the more solid REITs, they actually have enough money to do almost without rent for several months, some of them even a year or 2 or 3 years. And that is, of course, one of my conclusions when I get to that today, is that you need to, in this current situation, look at REITs that have a very strong balance sheet with low debt. I also have some other graphs for you here. You can see this one, performance by REIT type. You can see that the diversified and the industrial and warehouses, they are actually very much up. I don't recall the date this was taken. It is not here from July. I think it's from May or something like this. Self-storage is also okay, but there are apartments, healthcare, single tenant office, shopping centers, hotels and regional malls that were hit the hardest down here with minus 56%. Now you may argue that it doesn't really matter, because a REIT, at least if it is the equity kind of a REIT, they own the building and the building will always get back to its own value. And well, it might. But also, if we're looking at one of the large equity, the Realty Income Corp with ticker symbol O here, if we're looking at this one, you can see, yes, it is coming back in price, and we must assume that this is because of the real estate, that it goes up in price. But again, we can see that they're taking some very long dives here. We can see that from April 13, if you have picked the O here, the Realty Income Corp here, you would be in a break even just about here 7 years later. Of course, you would have collected some dividend, which was okay. But then let's take the Simon Property Group here, which has a specialty of investing in malls. And what you can see here is, someone would say, yes, well, no one knew really what that this crisis this year would hit. So we went down something like 56-7%. Yes, that is fair enough. But look at the overall trend. So every single of these REITs has their own structure. And as up until recently, it was kind of the idea or the philosophy that when you put your money into these REITs, that it was, I wouldn't say that it didn't matter which one you bought, but people just poured money into them. And as with many dividend stocks, people got a bit blind and simply just looked at the dividend. They liked the 8 or 10% in dividend, and they knew that they just had to buy on the dip. As for the Simon Property Group here, I know there are some special deals with them, but buying on the dip all the way down here would have been quite expensive, and it would take years for you to collect the dividend, so you would come into break even. So there are some significant risks here that you should be aware of. And when we're looking at sectors such as hotel REITs or retail REITs or something like that, some of them might actually never really get back on their feet, or at least it would take quite a lot of years. What I have been seeing when we're looking at the overall REIT, we can take the B&Q again here, is that they took a nosedive, as with all other sectors here in the spring, and then they have been, if you were good or lucky to catch it down here, it has been going up. Well, 40% is fine, and we are close to break even, and you get some dividends. But we have to talk about the risk, because there are a lot of risks that are always there, and then there are some risks that are here, especially right now. And let's have a look at these REIT risks here. Well, I've just put it down in bullet points here, and something like unemployment. And the unemployment right now in United States, and here I'm primarily talking about the US market, the unemployment rate is bad. And if you have seen some of my other videos, you know that the unemployment numbers you actually get from the government, and this is not to be some sort of conspiracy nut or tinfoil hat guy, but the number is simply wrong, and they admit that in the report from the Bureau of Labor Statistics, that it is actually way higher. And if you were looking at what is called the U6 unemployment number instead of the U3, you would see that it was almost double as high. So the unemployment rate is very high, and that means that a lot of people cannot pay their rent. And up until now, they have got some benefits, and I know they are negotiating right now in the Congress about a new one. And of course, it is soon to be the election day in November, so of course they will support these people. But it is just to say that this is an issue that we have to consider, that a lot of people may be not they may not be able to pay their rent. We have to look out for this government support. Will they give it, or will they primarily give it the support to the companies? Then there is the entire situation as with the virus. And I know it's not very popular to talk about, but if we look at this graph, we can see the number of new cases going like this and like this. And as long as this is going upwards like here, I have been talking about to my subscribers saying, this is not the worst part. The worst part is if or when this starts to show in the number of how many people dies. And what we can see here is that 4 to 6 weeks later, just as the scientists expected, this one broke upwards, and there's not really any sign of it breaking downwards again, meaning that a lot of the states will have to somewhat roll back their openings. They need to shut down. Another point I have here, they need to shut down the states, the bars, the hotels, the fitness centers, and so on and so forth. So there is a huge risk here. And what you need to make sure if you're putting your money into a REIT is how strong their balance sheet is. Because if they have a strong balance sheet, don't have too much debt, then this entire situation can actually be beneficial for this specific REIT. Because if the prices really plummet and takes a nosedive, then a REIT with a lot of money in the bank can actually make some good deals here, and that can be okay. Another thing I have said here is the strength and the weakness of the US dollars. And that is, of course, primarily if you are investing from outside United States. If we just take a look here at the DXY, which is the dollar currency index. And as you can see here, just since the spring here, the US dollar is down 8%. Meaning that if you had taken $1 million, bought $1 million with your euro, and you have put that into some REIT in United States, then if you hadn't been doing any currency hedging, you would be down 8% right now, even though you got some dividends and so on. So there is a currency risk. And as with right now, when we're looking at the insane amount of US dollars being printed, there is quite a high risk for the US dollar to keep going down, because they are pushing, the Fed is pushing the interest down. And normally, in a normal world where the economy follows the economy books and the teachings, then a lower interest would give a lower currency. And that might be what we've been starting to see now. So if the dollar is going into a tailspin lasting several years, you might actually see that your 3 or 4 or 5% dividend payment every year will be eaten up by a drop in the dollar. So that depends a lot on when you actually are planning to use it. Another thing, and that is, of course, it's not only with the mortgage REITs, but the mortgage REITs, as I mentioned in the beginning, they make their money by taking short-term loans with low interest, and then they're buying mortgage, they're buying debt that is going to be paid back with interest, and they are making money on buying long-term mortgage. And that, of course, has been great in the later years, especially since the financial crisis in 2008, because the interest has only been going down. It actually has since 2000 and so on. So the last 20 years, actually, this has been a great deal, because they have been able to refinance their short-term loans at cheaper and cheaper prices. So they have been making a killing. But what we will see at some point is that the interest will start to go up. And one of the things that can make it go up is if we start to see inflation going up. And again, it's not to be some sort of conspiracy nut, but the inflation numbers we are seeing from the United States right now, pretty much from all over the world, are manipulated in a way where we actually have a higher inflation today than the numbers show. I can make another video about that if you want to, but it's just to say that at some point the real inflation will start to show, and that will push the interest up, or at least that is most likely, and then many of these REITs will have a hard time because they might be collecting 4% or 5% in their long-term mortgage, and they have been able to borrow money right now at 1% or 1.5. But what happens if the interest rates go up to 3 or 3.5 or 4%? And I know if you are young and you're thinking, oh no, that could never happen, then you should definitely pick up a history book and see what has happened with the interest for the last 40 or 50 years. And if you're a bit more serious, you should go back and read about the Weimar Republic in Germany between the First World War and the Second World War, and see what happened with hyperinflations there, just to scare you a bit. A little warning here, you will not be able to sleep well at night for the next couple of weeks if you read about it. All right. Another thing is that when you're investing in REITs, then some of them, and this is where it will take a lot of research for you to find the best REITs, because some of these REITs have a business model where at least a part of their income comes from selling some of their properties when they've gone up in price. So they are renting them out, picking up the rent, maybe making the property a bit better so they can raise the rent, and then they can sell off some of their properties. There are some rules as to how much they can do this, but they can sell off the properties for higher prices. Just be aware that if they have to lower the rent, or if there's a downwards pressure on the rent, then that would dramatically lower the resale prices of their property, which means that that balance sheet all of a sudden is a lot worse, and maybe the bank or whoever financed this building will come and say, well, your building's not worth so much anymore, so we will have to get some more security from you, and some of them can't take it. We will see REITs that go bankrupt, I'm 100% certain. When you are doing your due diligence and diving into this, you will have to look at their debt or their leverage. You'll have to look at how much debt they have compared to how many assets they actually have. And I would definitely urge you to choose the one with the lowest leverage. I know that low leverage means lower performance, lower profit for you, but the next couple of years will be extremely volatile. And the ones that survive the next couple of years will probably be the ones that are not over leveraged. So that is just one thing. And then I recommend that when you are researching the REITs, you are diving into what sectors they are exposed to, and definitely hotels, retail, and so on. Keep away from these. There are some that are very good. There are these industrial and warehouses. Many of the companies that have been doing very well in this crisis we have seen are renting these huge warehouses. It can be e-commerce or something like that. And that is definitely a way to go. It could also be that you're looking at some sort of 5G ETFs or REITs, where some of these REITs are actually, they're not buying a building, but they own some sort of broadcast tower. That could be cell phones or something like that. And then they are picking up rent from that when the mobile phone companies, they need to use this tower. So there are some of these. I will make more videos about these REITs where I try to pick different sectors. But in this video today, I just had a urge to tell you about some of the risk, because I really think that people completely have missed this risk, or at least they have started to open their eyes now that people, the REITs all of a sudden plummeted 40, 50, 60% this spring. But up until that, I was really kind of talking to deaf ears when I was talking about the risks in the REITs. So, by the way, I just found an expression looking at the mortgage REITs. I was reading about them, and one of them were saying that they were actually also buying something called mortgage-backed securities. And that is, instead of just buying a single mortgage, they are buying a package of mortgages. And you can see there are a number of mortgages here put into a mortgage pool. Then there is a company that is slicing these up in different risk categories, and then they're buying this as something called a derivative, a collateralized debt obligation. Now, if you're sitting and you're thinking for yourself, where have I heard this term before? I can tell you, or at least I think where you've heard it before. If you have seen the movie The Big Short, which is a movie you must see. If you're sitting thinking to yourself, I don't know it, then, well, I hate to see it, but you need to stop this video right now and turn on Netflix or whatever you have at home, and you need to find The Big Short and you need to see it. Because what this is all about is this. And you can still, and these REITs can still buy mortgage-backed securities, and they are on the same slippery slope as they was up to 2008, where these mortgage-backed securities was pretty much the reason why the entire world's real estate market went belly up. So I was a bit surprised actually that this was still a thing, and yeah, well, I'll dive more into that as well. As a last thing I'll mention, and that is a risk I haven't mentioned yet, but many of you are buying these REITs because you want to get dividends. In the current situation, you need to realize that you can end up buying some of these REITs, and then they'll slash the dividends, sometimes not entirely down to zero, but as you can see here, I know it's very small, but initial dividend it says here, and current dividend. And these are all the dividend cuts we have seen just in this spring. And you can see there are some in healthcare, there are a lot in hotels, there are a lot in retail as well. Then there are a bit in some infrastructure and office building REITs and so on. But basically hotels and retail are the bit too big here. Just realize that if you're buying a REIT and you're thinking for yourself, it doesn't matter if it drops 10 or 20% over the next couple of years because I'm collecting my dividend. There is nothing so certain that it is printed in stone here, not at all. You can buy a REIT and they can drop the dividend down to zero, and then the REIT can go down 50%, and it will take you pretty much forever to build back your equity. So this video, I hope you see, is mostly about risk. And REITs are great, and I'm not saying that you should not invest in them, because I actually have a couple of REITs on my observation list myself, and I am interested in them, and I have been in REITs before. So it's not that it is a forbidden area, but just don't fall into the trap thinking that just because they are offering a nice dividend means that you don't have to care at all about your risk. Today, especially today in the market we see right now, you need to dive deep into every single of these REITs, and you have to consider who are the end user of the thing that this REIT offers. Is it tenants in a rental building? Is it a big mall? Is it a 5G antenna? And you have to assess whether you think that this rent payer will be able to pay in the future. You need to look at their balance sheet. You need to look at where you think the rent will be and what kind of debt these REITs have been taking on. You need to realize that if you're investing in USD, in US dollars, then you will have to assess what you think the US dollar will do, or if you need to hedge yourself. So it is not just putting money in a bank and collecting 8 or 10% as easy as nothing. It is a risky game. All right, that's all for now. I hope I didn't spoil your good night's sleep. And in the next couple of weeks, I will probably do a couple of videos more about specific REITs or specific sector REITs to have a look at what I actually think is a good place to start if you want to get into this nice dividend paying REIT game here. That's all for now. Take care of yourself and your money out there. And as always, remember to subscribe and like the video. Bye for now.